we have 4 amazing VCs here: Jacqueline, Paul, Dan, Beau, Laskey. I'd ask you all to introduce yourselves, and then I'm going to tee up some questions and then hand it off to the audience.
Hi, everyone. How's everyone doing today? Great, great. So I'm Jacqueline Blackburn. I graduated from the Naval Academy in 2013, went on and served 7 years in Navy Explosive Ordnance Disposal, stationed in Virginia Beach, did 2 deployments, one to the Middle East, the other one to Africa. After my time of service, got out, moved up to New York, worked at JP Morgan for 2 years, worked in their early stage venture capital coverage team, and then also helped build out the early stage tech banking practice in New York City. From there, broke into VC and started at Scout, and now I'm here an investor at Decisive Point.
So I'm Paul Madera, and it's a really terrific pleasure to be here. And I say that because I got started in this business about 30 years ago, which is why Tim has a few things to say about me. But it was pretty lonely getting going. And I say that because there weren't any veterans really around tech or venture. And over the past 30 years, it is just remarkable to see where things have gone. And I actually had no idea there were this many vets involved in our industry now. And thanks to you, Tim, for getting us all together both last year and now this year. And Tim, by the way, for those of you who don't know, started service to school back several years ago when he was a GSB student. And he is helping dozens of veterans get into great schools who would not otherwise get there as a result. And he finds time to put on this conference, and he finds time to run Context Ventures, which I have no idea how you do this, Tim, but thank you for doing it. I got started as an Air Force guy, grew up in a Navy family, saw F-4s flying over Kaneohe Marine Air Base as a young child, and decided I wanted to do that. Went to the Air Force Academy, did fly F-4s as they were just retiring out of active duty, and then converted into the early models of the F-16. And from there went to Wall Street, worked at a couple of investment banks over the years doing IPOs and private financings, and then started Meritech back in '99. And since then, we focused on later stage investing, which we'll talk about a little bit, and funding many of the tech companies that you read about today. So pleasure to be here.
Is this working? There we go. Well, I already kind of felt a little under attack with all the Army and Air Force people here, and then when I saw this whole panel of JP Morgan folks up here, I was a little blown away. No, but it was an awesome presentation by the JPM folks. I'm actually Beau Laskey with SVB Capital, which is Silicon Valley Bank, so one of the competitors of JP Morgan. I've been here for a little over a decade now. I got started back in the day, class of '92 from the Naval Academy. Came out of Georgia, got up to Annapolis, and then went out to the West Coast for the real first time. Went through BUDS and went into the SEAL teams, did a handful of deployments on the West Coast, switched coast to the East Coast, and then went back to grad school and kind of got into this business. I think we're going to talk more about it, so I won't get all into it right this second, but been in venture for about 20 years or so. And then what I do now is we have a group called SVB Capital. It's about $10 billion of capital. It's all outside capital. We don't have the balance sheet that JPM does. We don't have the private bank that JPM does. So we actually raise all of our own capital. And so we've got a series of venture funds, we have a series of fund of funds, and we have a series of private credit funds. And so that's what I've been doing for the last 10 years.
Hey, good to see everyone here. My name is Dan Gwak. I run the private investments business at Point72. That's comprised of Point72 Ventures, Growth, and our private equity fund, Hyperscale. I am on this panel because it appears that I'm the one enlisted person who snuck on here with an invite somehow.
Went to Harvard first, though. Come on.
And just like that, credibility gone. Anyway, it is an honor to be here. I do want to thank Tim. I've known Tim a long time and can point to very few people who have been as committed to veterans and veterans in tech and veterans going to good schools and so forth than Tim. My quick 30 seconds. I started out life as a banking analyst, joined a private equity firm called the Carlyle Group, and And then when the recession hit, of course, burned it all down and joined the Marine Corps as an infantryman. Did that, went to business school, and then ended up at a place called InQtel, which I think the panel after this, Steve Boucher, who's the president of InQtel, is speaking. But it was a great place to learn, to work, and for the last 6 years, I've been at Point 72.
Awesome. So first question, you all can go whichever order you want. What's your current investment thesis, and how has it changed over the course of your career? Jacqueline, how about you go first?
Sure. So I'm fairly new in VC. I started a few months ago full-time as an investor. And I think right now I'm at this point where I really love the defense space. And I've been able to be at both Scout and now here at Decisive Point, focusing in the early stage. And so at Decisive Point, we're early stage fund. We focus broadly across the sectors of defense, energy and infrastructure, and health. And for us, it's really a value add in terms of with every investment we make, we're able to help these companies, not only in the commercial sense, but also in the defense sense, in terms of like providing non-dilutive sources of capital to these companies. With every dollar we've invested, we've committed $15 back to the company in non-dilutive capital. And so, as a veteran myself, there are a lot of technologies that we have the capacity to use within the DoD. And so it was oftentimes frustrating as, in the armed forces to not have that technology. So being able to provide that impact to the modern day warfighter is something that I value not only personally, but now also professionally. So it's great.
I'm happy to go. So let's see, kind of the arc of my career. I got started, as I kind of mentioned, I was in grad school, and there was a small fund that had just got started, 3X operating partners. I think they were probably mid-50s at the time. It was 2 guys and 1 gal. They had run some technology businesses. I was actually at University of Michigan at the time doing grad school. I had no money. I had 1 kid and my wife. And I happened to find this small fund. They'd raised effectively a $7 million fund. So I started working for them and really just doing typical analyst type of stuff. And then I went off to Morgan Stanley for the summer, did iBanking with them, had an offer to go back to iBanking, ended up saying, hey, I really want to be on the principal side of the business. I really want to help grow companies. So I jumped on literally the day of graduation. They gave me a job offer, and I had to send back like a $25,000 signing bonus to Morgan Stanley. But it was a great decision. I really enjoyed what I've done. And then we went on to raise a $30 million fund, a $55, a $75, and then $85 million fund. And I think kind of how things have changed since then. You could afford and you could be more of a generalist in the venture industry. You could do, partners that did healthcare, partners that did IT, partners that did semiconductors. The world has become much more specialized, is what I've seen, and then as well as at stage as well. So now you have like your seed folks, your Series A folks, your early growth. You've got growth and kind of beyond. And so I think just more specialization has been a major part of the trend that I've seen over the last couple of years. And then in terms of what we're focused on now, primarily Series A, Series B, first and second institutional rounds. Typically, first check is kind of in that $7 to $15 million range. We can go higher, we can go lower. Kind of the 2 big sectors for us, fintech is a big area, enterprise software, and then obviously there's subsectors within those big categories. And then we raised a $100 million SMA just to do climate investing or climate tech investing. So those are the 3 big categories where we spend a lot of time today.
Yeah, I think that's a great point about specialization. I mean, venture has gotten so competitive now that there, aren't a ton of generalists still out there. If I were to describe, Point 72 Ventures and the way that we operate, it would be domain expertise, right? So we have, over 100 portfolio companies deployed over $1 billion. But we are very much specialists in a handful of areas where we feel like we know the market reasonably well, right? So we've got a fintech team, we've got a deep tech team, we've got a core enterprise team, we've got a defense tech team, and those are really the core areas where we look. the venture world has gotten competitive enough that that specialization is, I think it's really starting to take hold, and we lean hard into that, right? And so, that means that I think when we show up and talk to you, and you're a founder in one of those industries, you'll find us to be pretty well informed, right? However, if you're not in one of those industries, we're probably not going to be a great partner for you, right? And we make that choice proactively because we can't know everything about everything, right? And so those are the areas that we invest in the most actively.
So over the past 25 years, I think about that question as kind of in two factors, if you will. One is sector, and the other is stage. And we at Meritech have been focused on the later stage ever since. Many venture funds have raised much larger pools of capital, and they've spread themselves out. So if they were early, they've gone late in addition to early and maybe public. If they're late, they've gone early and likewise. We've been kind of a one-trick pony. We stayed focused on later stage, Series C, Series D rounds, generally 12 million or greater in terms of revenue run rate, and that continues to today. But the sector part of it has changed dramatically. When I got started in this business, we could only invest in a certain limited set of technologies that happened to be infrastructure build-out for communications, fiber optic switching, hard drives for PCs, and semiconductor chips for graphics and the like. There was no software at the time because Microsoft was pretty predatory at that time, and anything interesting that was software, they would come after it and they would run them over. And so no VC would write checks to software companies. Today, of course, 2/3 of what the venture industry is putting their money into is software companies. And then there's a lot more things now that qualify for venture capital. So it's been a dramatic change, and I actually think it's quite early in terms of the software revolution that we will see play out, and you all will be a big part of it as you find different ways to deliver ROI to businesses and to consumers with the software products that will come out of this room and across Silicon Valley and elsewhere across the country.
What advice do you have for the military veteran founders in this room that are, say, somewhere between 2.5 to 10 million annual revenue and are looking to fundraise?
For 2.5 to 10 million?
2.5 to 10 million annual revenue, or let's just say like pre-seed to Series B stage. And this is a question to all panelists.
Yeah, I think you guys may be better suited than me.
Or said otherwise, what's the market environment for founders trying to fundraise?
Yes. For right now, yeah. Okay, so I think that's a little simpler to answer right now. I think the growth, and Paul can answer this, but I think a lot of the growth is locked up, right? And it's going to stay locked up for quite some period of time, I think. Everyone is looking for kind of what's the correct market pricing at the later stages. And so I think that world is pretty well frozen up. But at the Series A, Series B, I think even at the seed, I think the second half of 2022, there were still like 5,000 seed and Series A deals that got done. So there's still a lot of activity that's out there, especially if you're talking to some of the smaller funds, the seed funds, the Series A funds. So we're seeing a lot of capital still get deployed. It's not at the same quantum that you're seeing where people were writing $200, $300, $400 million checks. These are, $3, $5, $7 million checks, but we're still seeing a lot of activity if you can get to the right funds.
Yeah, I think locked up is probably the right way to describe the market, especially in the later stages. And there's a very understandable reason for that, right? Which is that in the public markets, which is where you expect these private companies to trade once they exit, valuations have come back down to earth in a pretty serious way, right? And so when you apply those valuation multiples to what private companies are doing today, a lot of times you'll find that valuation today is below where folks raised in 2021, right? 21 was like an absolute banner year, and every company that had reasonable traction went out, raised a huge round at a big valuation, which was the right move at the time, and they've still got a lot of that cash, right? And so right now it's a little bit of a staring contest because I think for us on the investor side, we have to pay a rational price. On the founder side, obviously you don't want to take a down round if you don't have to. And so I think that's why, a lot of the later stages are kind of locked up. In the earlier stages, that's a little bit, like less the case, right? So I think in a seed round, you're still looking at, quality of founders, markets, technologies, things like that, and that still seems to be moving. I think the staring contest kind of resolves itself naturally, right? Eventually, companies either need the cash or they don't, right? And at that point, the valuation that the market is willing to support is what it is, right? And I think high-quality companies will still raise, right? I think companies that are going to be successful are still going to be successful.
So locked up is the right term. We at Meritech haven't done a deal for the last 10 months, and the reasons are very simple. So many great companies, and we're looking for those companies that are big enough to go IPO. So many of those had access to essentially free money over the last 3 years that almost every round that was done by late-stage firms over the last 3 years was overpriced. And some companies are getting close to growing into that round, but most are not. And one of the things that's great about this group here is that most of us here are really younger, smaller companies. So you aren't stuck in that sort of zone where you don't want to be. I mean, one of the issues we have as investors is we never want to tell you entrepreneurs that you're not worth what your last round was. Then you don't like us, you don't want to talk to us, you don't want to come back to us later on. And so we would much rather just not talk. And that's a lot of what's going on right now.
Don't want to be the bad guy.
No, we'll let them be the bad guy. So it is a tough situation. What happens going forward here? I think it extends for quite a while yet. An awful lot of companies raised money, and they have big fat balance sheets, at least in the later stages. And we're not going to see arm's length, rational market pricing until they burn down some of that capital and they have to go out and really negotiate for the next round.
I would add, so fundraising sucks. I don't know if you guys are currently fundraising, have fundraised in the past. As an investor, as a founder, it's not cool, it's terrible, and it's not fun, right? So like everyone hates it. I think we can all agree. I think, in terms of what we're seeing at the early stages, investors are taking a lot more time to diligence a deal. So expect like longer timelines in fundraising. Also, I think too, building a cap table around strategic partners that are going to help grow your business. So spending time with those founders or those investors as a founder that understand your business, that have been through a 0 to 100 timeline with a company of a similar sector is very important to you. So when you're not fundraising, making sure you're building your network and providing, a partnership and an opportunity for you to build a network around people that understand your business. And I think too, to the other panelists' point, we're seeing a lot of down rounds, we're seeing a lot of flat rounds. I think it's really important when you are going up for your fundraising to think about structure of your term sheet, right? Like how does a certain structure in terms of how, you're positioning yourself in front of investors going to be helpful for you in the long run?
Yeah, one thing I'd add, just real quick, just over the last 6 to 9 months, and this is definitely true at the early stages, but maybe even more true at the later stages. Everyone's trying to access debt instead of doing equity, where they're going to have to take a down round or whatever. If they can take debt, kick the can down the road a ways, that has been a big strategy for a lot of folks. Now, not everybody can do that. For the last 6 to 9 months, the phone has literally been ringing off the hook by pretty much every startup company that's out there. I think it's a very valid way to finance your company. You just got to make sure you're going to be able to grow into the valuation, and now you're not stuck with a big chunk of debt at too high of a valuation.
When military veteran founders have pitched you, what are your lasting impressions as a cohort in terms of their strengths and their weaknesses, and how should they refine their pitch to you all?
I'd love to talk about that. As vets, you have some specific disadvantages, and you have some great advantages as well. I mean, those of us who served, you kind of are missing several years that our civilian counterparts got to have when they went to undergrad, and if you went to a civilian school, obviously you had friends and contacts who went into business who you could keep track of. If you went to a military academy, you don't get any of that. So what happens? Actually, I will say as a venture investor, I know my colleagues across the industry actually see veterans as a bit of a shiny, fascinating object. There aren't many entrepreneurs that show up looking to raise capital. They are by and large patriotic, so they want to hear your story and they want to be supportive if you can. They view vets as maybe a little bit naive in terms of running businesses, but also very receptive to learning and very focused on delivering what the mission calls for, which is your company's success and so forth. It's a tremendous advantage, and you should play that up. I would also encourage you, and you're probably doing this already, but you should actually go and make the rounds to all kinds of investors, even if they don't fit you for what you're trying to do currently. And that's because you will find those folks will be available and remember you and be interested years from now when you're a bigger company and more successful, and you have the chance to go back to them and they remember and they see what you've done and they're more inclined to invest in you.
Yeah, no, I think that's great. I think for me personally, and for a lot of the vets that I've seen, I think one of the number one, I'm just thinking this through here, I think the number one challenge is most vets don't know how to sell themselves, and most vets don't know how to sell their company. And I've you know, because most of us come out of this world where we're super humble, it's all a meritocracy, I don't want to beat my chest, all that. But when you get into this world, you kind of have to. That's what you're competing against, and unfortunately, there is a big chunk of salesmanship involved in this world. So I think that is one of the number one challenges that people have to focus on. I do think, in terms of one of the strengths, I think there's almost an inherent trust in a lot of ways when they're talking to former military vets, et cetera. So those are two of the key things that I focus on.
Yeah, I think the point about known strengths and known gaps is something to kind of be cognizant of, right? I think the good news is that as veterans, a lot of us have experience kind of building teams and making sure that team is successful in the aggregate, right? Not a team of individuals who are all well-rounded across all the skill sets necessary, but assembling a team, who each individual might have gaps, but in aggregate is a high-functioning team. And I would think about kind of the startup journey a similar way, right? If you are the founder of a startup, if it goes even reasonably well, right, you're within a couple of years of managing people who manage people, right? And so there are probably things that give you an advantage over time, having assembled teams, having run teams, the EQ behind that, and so forth. But you probably weren't spending the last 10 years writing code, right? And so, don't try and figure everything else out, yourself, right? I would say assemble the team that can get the thing done.
I would say the first thing I think I look for, in the early stages is what is the team and culture and what is their long-term vision? What's their entry point? What's their North Star? And I think if you can answer those questions as a founder, you're a step in the right direction. I think too, especially at the early stages, being an early stage founder is a lot like being in the military. And I think it's taking me a little bit to kind of create this analogy, but if you think about it, when you were at least, in my situation when I was in EOD, I was responsible for an 8-man platoon on deployments. We would go out and we would train. We'd be, running missions round the clock, 24/7, or at least be on call, right? And so it's very mission oriented, and it's a very small, close, tight-knit team, and that's very similar in terms of construct to a company you're starting, right, as a founder. So I think being able to leverage your skills, soft skills, that being like being a good communicator, creating good culture within a team, building from the ground up, being very mission oriented, all of these things are directly applicable to what we do in the civilian world. And I think that's something to be recognized and something to be valued. And then too, also, not, you're not expected to know everything, right? Which is why you build a good team, to Dan's point. So just, know your strengths and know yourself, and don't be afraid to be like, I need help. So
I'm going to open up to the audience and want to see if there's anyone who has a question.
Yep.
So my question for you is, over the last few years, there's been a lot of talk about category design and positioning. I run a company, Iron Media, we produce podcasts for better known brands. But one of the weaknesses I identified amongst a lot of vets I talk to is, how do you position your product or service in a category with strong demand? And there's a couple of people that are pounding the table on this. You got Chris Laskey, who wrote the book Play Bigger, Bruce Cleveland wrote Versus Attraction Gap. He was here speaking. And market engineering, category design, like there are people that are stressing how important this is, but by and large, I'm seeing a lot of our community is still not getting it. So for the investments that you guys are making, I saw GoPro as one of them. Can you talk to how important it is to really understand and build out that category and how that factors into the long-term investment strategy? Because one of the things I try to stress people to do is identify that beachhead category first, and then share how this can expand into something bigger, potentially for so you think Salesforce, CRM, Fitbit, wearable, and some other examples.
Well, let me address that a little bit, because I do think there are a couple of major categories and then there's micro categories. The major category would be B2C or B2B, and then within those there's micro categories. The big secret about venture capital is that we're a bunch of lemmings, by the way. We want to go invest in things that we saw worked already, and they're in categories that are proven, and we're less likely to lose our money. And the irony is, the really big outcomes have come from the newest entrants in interesting categories that nobody knows how big they are yet. I mean, if you think about it, Google, Facebook, Salesforce you mentioned, those were all brand new leading products that no one had any sense for the size of the market. And they all had a little bit of trouble raising money, at least to start with, because it was unknown. In fact, Mark Benioff at Salesforce could not get Silicon Valley to fund him, and he went running around Sand Hill Road over here for months before he turned to his buddies at Oracle and got them to put money in so he could start building the business. And then after we saw that it was working, venture capitalists got interested. So the reality is, it's kind of a trade-off. If you can identify a really interesting category and you know it's going to be big and not everyone else is doing it, you might have something that's quite interesting, but it can be harder to fund.
Yeah, we don't do a ton of consumers, so it's maybe not as relevant. I know you were investors in Facebook. We invested in Airbnb. We invested in Twitter. Did GoPro as well. But I think the thing, like with GoPro as an example, with Nick Woodman, who is the CEO, the thing that he really did early, which I think was very positive, he focused. He was super laser targeted at extreme sports. He started in surfing and then went to skiing and just built that very, very deep, not very wide, but very deep, and got it very embedded into the culture. And then he was able to grow that into a very substantial business. So that, typically you see some people wanting to go, a mile wide and an inch deep. I typically have not seen that be super successful. Everyone wants to be the platform play, but it's super hard to be a successful platform play. There are some out there, but typically they burn a lot of cash and go out of business. So the easier way, or the more straightforward way, is to be a focused player, I find.
I mean, as I mentioned, we don't do any consumer deals, so I'll just go ahead and say this one's way out of my league.
If you're asking venture investors your product strategy, don't do that.
Yeah, I think too also being an early stage founder is difficult. You think about how businesses evolve over time. You think about Amazon, right? They started out as an online bookstore. You think about, Tesla. They were on the verge of bankruptcy for several years, and Elon speaks openly about that stuff. But I think maintaining your North Star is really important, right? Like thinking about what is that vision that you have for your company, and then how do you start small to get that attraction, to get people for you to solve a problem or make an impact in someone's life that will, over time continue to evolve and create greater impact because it impacts more people, because people need this piece of technology or this product. So I think, keeping your eyes on the prize in terms of having a roadmap, having a vision, yes, it could change or, change in terms of like sector focus from time to time, but just making sure that's always aligned and going back to that, I think is, a path towards success.
Mark Wolf at Oath. I think what we're doing here is great for our veterans in the U.S. Armed Forces. And I'm just curious, because I work with a lot of allied partner veterans who are entrepreneurs themselves. And what I hear is there's just a very hyper-competitive market for fundraising. So it's not a surprise to hear it's happening here, but we're really doing a great job to lower some of the barriers and for us. And is there anything that y'all are thinking about with your own funds that when somebody who may not be a U.S. military veteran but is a veteran and their ROI, they're going to build companies that are going to have extraordinary value. Maybe y'all are thinking about this or not, but when it comes to non-U.S. military veterans, what are y'all thinking? Are y'all looking at them?
Non-U.S. military veterans. I mean, so one of my partners is Israeli, and so we've done a fair bit of work in Israel. And we invest in some funds in Israel, and so we've got some partners there as well. But we found a lot of success with the Israeli military, specifically cybersecurity, the 8,200 groups, stuff like that. And so we're excited about those folks. I think the challenge for a lot of, they typically have to be U.S. companies. I think that might be part of the question as well, as they have to figure out how to have a U.S. structure.
I think I speak for all of us in that we have a soft spot for the military, mostly U.S., but foreign as well, allies and so forth. And I get a lot of requests for meetings, but if there's a military story attached to it, I am really interested in hearing it. And if we can't fund you, at least we can talk about ideas and alternatives and other things that you can do.
Yeah, I'd agree with that. I think, ultimately whether, a company gets funded or not is on the basis of the merit of, the company. That being said, it's a competitive world out there, right? And so oftentimes the thing that stands out is some common bond, right? Military common bond, even among our allies can be a very strong one, right? And so, oftentimes getting the conversation kind of feels like half the battle, right? And so it certainly helps from that perspective.
Yeah, and to everyone else, to the rest of the panel's points, I think it's also important to build relationships with folks internationally that do have similar backgrounds as you, because it provides just an alternative perspective. That's how you grow as a person, is having these very varying perspectives and understanding the world around us.
Hi, Nathan Cole. I'm an early and growth stage investor, so staying on that theme of competition. With so much capital that's come into the markets, private markets specifically, and the competition that's created, and then kind of skewing more towards specialization, what would you give as advice to a generalist? Because it's kind of hard to go from generalist to specialist.
I have several ideas on that. When we got started in later stage capital, there was no later stage capital, and we had a lot of problems getting LPs to think of us as a legitimate place to put their money so that we could invest it. Today, of course, it's a huge category, and it is very competitive, as you say. I would encourage you to do a couple of things. One is, don't follow the shiny object. We have all fallen guilty to hearing about what Sequoia Capital is doing, or Andreessen Horowitz, or some of the big names in the industry, and we think instantly, it must be a great company, a great opportunity. I should follow on if I get a piece, like FTX, for example. And we actually did do a little piece of FTX, I'm embarrassed to say. We had some young partners, and anyway. So one is, don't follow the shiny object. the second thing I would suggest to you, and I hope there aren't a lot of crypto fans in here, but don't do crypto. Personally, I recommend against it. Thirdly, do your own work. Make sure you really understand what you're getting into. Understand the dynamics in that business, understand the management interaction that they have, understand really how big their market is and so forth. And then lastly, remember that it's the entrepreneur who really makes it happen. We're kind of financial geeks. You entrepreneurs are the ones who really deserve the credit and the success when you make it work. You take more risk, you put it all out there, and then you have to live it 24/7 to make it happen. And we're just kind of a sideshow. And we venture guys have to remember that, and we don't always do that.
Yeah, I guess I would just say, I mean, even though you said you're a generalist, I think you can become a specialist. You know, you can become a specialist over time. I mean, if you look at JP Morgan, you look at SVB, you look at all the banks, these banks have been around forever. I think it said JP Morgan since 1799 on that slide or something like that. But look at all the fintechs that are freaking killing JP Morgan and killing SVB and killing everyone. And they've only been around for 3, 4, 5 years. And a lot of these folks are in their 20s and 30s doing this type of stuff. So just because you might not be a specialist today doesn't mean you can't be a specialist tomorrow. So I think it's figuring out kind of the macro framework, where is it you do potentially want to specialize. Maybe you don't want to just choose one. Take a look at 3 different areas and then start to hone in on one. Where's your passion and what's interesting to you?
How you doing? Derek Herrera in the back. Question for you, Beau. I'm a happy client of SVB, and you guys have some really unique things. One thing I was curious if you could elaborate on and share, which I thought was one of the unique things that you offer, is the fund and the investment opportunities with, making direct investments into different companies for your entrepreneurs. Can you share a little bit about the process you guys have, the check size, leading or co-investing, and all those sorts of things that you do with your fund?
Yeah, so on the direct fund, so Fund 6 is a $350 million fund, primarily Series A, Series B, like $7 to $12 million is kind of a typical first check. We'll do less, we'll do more. And then the 3 sectors I think I've already mentioned, which are, fintech, enterprise software, and then not clean tech, call it more climate tech, more capital efficient type businesses there. Our process is simple. We're not, basically the 3 of us, there's 3 of us that are the investment committee. It's me, my partner Tilly, my other partner Sulu. The bank has no input into what we decide and what we invest in. So we operate it as a pure for-profit venture fund. It is not a strategic fund. It's all about returning capital and returns to our LPs.
How's it going, everyone? My name is Clay Petty. I'm a Navy submarine veteran. I'm wondering if the panel can speak on how veterans may get into venture capital to be venture capitalists. And I say this because I was fortunate early in my naval career to have been afforded an opportunity to work at what was then the Defense Innovation Unit, and got liquored up on the idea of early startups and helping the warfighter. That was really unique, and then I had to go off and do the actual real Navy thing. A little less exciting. But in any case, as I was recently transitioning out, realized, wow, how does one get into VC? That sounds so cool. I've had this nascent, kind of interest back a number of years ago. Did a lot of Googling, a lot of phone calling, and found that there really is no straight line into VC. So I'm just wondering, and I've heard this before, that everyone kind of cuts their teeth on different things, but if you have recommendations for veterans out there in the audience right now who are interested in getting into VC, recommendations and steps that you think that they could take for career moves in order to one day be a successful VC. Thanks very much.
Go ahead, please, Dan.
I was just going to say, I think fortunately and unfortunately, the answer to that question is that the path for a veteran into VC is not radically different from anyone else's path into VC, right? For example, we've got a few veterans on the .72 team. In fact, I'm going to embarrass these 2 guys because I see them right here. Chris Morales, Naval Academy grad, former naval aviator, and Eddie Kang, West Point grad. Their path is like an example of that, right? They weren't hired because they're veterans, right? By the time we hired Eddie, he had been in investment banking, had worked at 2 growth shops, we were very fortunate to be able to bring him on to .72. Similarly for Chris, He had spent a lot of time in the Navy, but had a JD MBA out of Wharton. And when we hired him, he was on the Goldman TMT banking team, right? And so, that can, again, I say fortunate and unfortunate because, it's not like a path that is, kind of foreclosed for veterans, right? Those are things that we can all still do. It might feel a little bit unfortunate because it's like, wow, you don't get a ton of credit for the time that you spent in service, when it comes to competing for that venture job. But I think the healthy way to think about that is it's one of these things that helps you be, call it 5% better at the job every year, right? And so, yes, on day zero, that's like a 5% difference. It doesn't feel like a lot. If you let that compound over time, it can be quite meaningful, right? And so I would say, yeah, fortunately and unfortunately, quite similar to anyone's path into venture.
I think if you look up here, you'll see several different categories. You see Jackie and myself, who actually came over from banking. That's probably a little tougher to do, to go into venture these days, but it's really easy to go from banking into private equity, so larger buyouts. And that's a much bigger pool of employees and opportunities for all of us. You find Beau, who actually, practically started his own fund and got started from the ground up, which is really a very difficult way to do, but it is possible. And I know there are several here who are starting their own funds. And then you have Dan, who was at a tangential, or I should say adjacent firm at In-Q-Tel and went straight in. We've got Hsia right over here, who started his own fund and is off to a smashing start already. So there's several different ways. I will say I've gotten asked this question a lot over the years, and I actually took a poll of everyone I knew in the venture industry a few years back, and the most common background that I found was the head of marketing at a successful startup, actually. And when you think about it, it sort of makes sense. The head of marketing tends to be very thoughtful about the sector that business is in. They become an expert. They may have just gotten their MBA, or they've just out of school for not that long, but they become the CEO's right-hand person to understand an industry, the dynamics around it, how do you go out and grow the business, and that leads to relationships with board members and others in the VC industry who want to get to know that sector, and there becomes opportunities for them.
Yeah, I'd agree. I kind of, when people ask me this question, I think there's kind of two ways. There's kind of the way that I did it, which is like hook and crook. You just kind of find your way in and navigate in and get an internship and then build relationships and then raise your own fund or whatever. Mike Burns here is another one. UNC was in the SEAL teams, found his way to Sway Ventures, and I tried to hire him, but we weren't quick enough, and he went to Canopy Ventures, and they just closed like an $800 million fund, so they're killing it, doing extremely well. But then the other path is going through what I would say the product path. With product marketing, I haven't done a survey, but in my head, when I think about it, people that have run maybe some P&L or something around product that's specific to the needs of that venture fund, and then you can get recruited in or come in maybe as a principal or a partner, depending on the level.
I would say building a strong network is really important, and I think that starts with doing research, finding out about what deals are being done, what is most interesting to you in terms of like funds and what people are investing in, getting in front of those funds, whether that's the associate role, and just working your way to build a network within a larger ecosystem. I think that over time is hugely beneficial, but I think too it takes a little bit of reflection on yourself to figure out who are the people that you look up to in the venture community, who are those funds that you look up to, and then how do you get involved in building your network from there?
I like to actually jump in and chime in on two things there. First is that what Jacqueline said, relationships. And I brought this up earlier, relationships compound. So Paul, I met at my first year of business school, and I was like, wow, there's a veteran VC who's doing a case study. I kind of want to be like him. I went up to him, I was like, I kind of want to be like you one day. Like, I just want like a sliver of your success. And then Dan Gwak, like later that year, he was at In-Q-Tel, and someone, I forgot who connected us, someone said, oh, you should meet Dan Gwak. And so it's like you just try to build relationships. And Beau Laskey, the reason we actually do events are terrible, by the way. They're just time-consuming, terrible in terms of revenue, but in terms of meeting people and having an excuse to meet people, events are great. And so I go to a ton of events, and I do that just to meet people. It's an excuse to meet people. The second thing is, venture is actually not that great. It's really, really hard. And actually, I want the panelists to talk about how hard it is. And so I think everyone's like, oh, you get to be on the buy side. But I know a number of VCs who sometimes wish they were entrepreneurs. So real quick, I'd like you all to talk about, everyone thinks VC is awesome. Is it as awesome as people make it out to be?
No. No, look, I think there's a lot of ways to make money if you're in it for money. I mean, and I have friends and colleagues and people that have, one friend, he bought a company that manufactures end caps that go on steel rebar, and the company does like $75 million a year, $10 million in EBITDA, and he makes a flipping killing. Like, so there's companies that are like that. There are companies that are, technology businesses that are interesting. You can do seed, Series A, Series B investing for a long time and never see a carry check. I mean, that's the untold, story in venture, is there's a ton of people that have been in this industry for 10, 15 years, and outside of seeing, decent salaries from management fees, they've never seen upside from their carry or the equity that are in their portfolio companies. And I think until maybe the last 3 years, somebody said that on average, no one's seen a carry check in like a decade. So it's not where you just, you raise a fund and all of a sudden you're doing extremely well. When you raise a fund, that's the start. Now you're like, okay, now you're in it for at least 10 years before you probably see much.
I will second that. It is really hard. It is tremendously hard. I'm lucky that we actually had one investment in our first fund that did well enough that helped us survive for the next 6 years when we couldn't raise money to make it to the next place to raise. We didn't see carry checks at Meritech until we were 12 years into it. It is really, really difficult. I mean, it is fun. I mean, we get to come to things like this. We get to meet these wonderful entrepreneurs. We get to hear about new technologies and different ways that industry is going. And you get to meet kind of the crazy minds that are coming up with the next generation of interesting stuff. But it is a very, very difficult, grinding, demanding job in order to make it work. And even when you put all that in, many times it doesn't. So it is, in many ways, it's like iBanking. I used to think as a business school student coming out of the Air Force, that's going to be so great. I'm reading about those guys flying on the Concorde to Europe. I want to do that. And this is back in the 80s, guys. And then I got there, and I was standing at the copy machine at midnight making presentations for the young associate that I had to deliver stuff to. And VC isn't quite like that, but it can be really, really tough. And I know you CEOs and entrepreneurs have very similar stories as well.
Yeah, very so. I mean, one thing I'll just add, if you've got a portfolio of 10, 15, 20 companies, you always have a handful of problem children, that you're dealing with. There's always a problem. It's never like, hey, you're just sitting around hanging out. There's always an issue with something, somewhere, somehow. And so you don't really get away from that stress.
I actually really love being a venture capitalist. And maybe it's just because I've only been in the hot seat for a few months, but I don't think I would do something if I didn't love it, right? Just because, things are hard doesn't mean you can't enjoy what you do. I think that makes you better at your job when you actually enjoy the work you get to do. Not every day is, a bucket full of roses, but I think that that's in any job. You're gonna have, things you like about that job and things that you don't want to do about that job that are like administratively intensive. But I think too, thinking about the ecosystem as a whole, I have a lot of friends in VC, right? Like it's a great community of people. It's collaborative. It's difficult and challenging at times, but you're seeing such great technologies. You're setting up the future for your children, right? And for the young kids today. And I think that's incredibly important and incredibly impactful.
Yeah, I mean, I would say like anything in a competitive world, anything worth doing is hard, right? And so, you know, I won't say venture is easy. Like nothing worth doing is. However, going to the point of like, well, are you going to love it? You know, I think about that question the same way I've thought about any job, right? Think about what the work entails, right? And then think about that doing that day in, day out. Don't think about, you know, what the press is saying about the job or what your friends say about the job or whatever, but just think about, okay, what is involved in the work of that job and would you enjoy it, right? You know, in some cases, like everything that's worth doing is going to be hard, but sometimes you look at the work and you're like, yeah, I kind of want to do that, right? You know, when I think back to, you know, being an enlisted Marine, right? Like there was, yeah, I mean, it was hard. I mean, you're going like 3 nights without sleep, you're getting rained on, you're going borderline hypothermic, but, you know, like, you know, you're like, we're all veterans here, like you probably signed up because you kind of wanted to do that to bring the fight to the enemy, right? And so, you know, if you think about, okay, what am I actually doing day to day in the job? Do I think I will enjoy that? You'll probably have your answer, right? It's also a great way, by the way, to filter out things you don't want to do, right? I mean, for a minute, I was like, oh, maybe I should go to law school. And I'm really glad I didn't, because, you know, the question I would have had to ask myself, and my wife is a lawyer, by the way, so I'm not just like, you know, saying that this is a terrible industry or what have you, but, you know, like the day-to-day work is reviewing documents. And I would literally pay somebody $1,000 an hour to review a document for me so that I don't have to do it, right? You know, I don't feel that way about venture, right? Like yes, the hours are long, the work can be hard. There are definitely good days and bad days. But ultimately, you know, the work is something that I find to be fundamentally enjoyable, right? And so I think that's the easy way to think about whether you like it or not.
Who here likes fundraising? If you like fundraising, then maybe get in the venture. But if you don't, it's at least on an easy day, 25% of your day, and it could easily be 75 to 100% of your day in weeks and months as you're going through this.
Good afternoon. I'm Lisa Song Sutton, General Partner with the Veteran Fund. Thank you for being here, number one. My question is, what is your advice to emerging fund managers who have had great success raising LPs through ultra-high net worth individuals, but now are getting ready to break into that next circle of family office, financial institutions? Any advice or insight you guys have would be greatly appreciated. Thank you.
Yes, there is a transition for emerging managers going from friends and family and family offices into institutional LPs. Institutional LPs are a little like VC funds. They have gotten bigger and a little more discerning and so forth over recent years. I will tell you, I think it makes a lot of sense to try and reach some of those institutional LPs long before you go see them. Many of them will meet with you, particularly when you say, I know you're not my target audience. I'd love to come by and tell you my story and collect your advice. And they'll remember having met you and what you had to say and what you plan to do. And if you come back in a couple of 3 years and you have delivered on some of that, they will be more interested in you.
Yeah, it's a long burn with an LP. I mean, I've been calling on certain LPs for 5, 10, 15 years. University of Michigan has been telling me no for 15 years. I still call them, but whatever. But you've got to have the persistence and the consistency of continually following up. I would say do not, have your first outreach be, hey, I'm raising my next fund. But I call it as friend raising. You're always got to be in the mode of friend raising, whether you're an entrepreneur or a VC. It's always about friend raising over time. And then as you start to move from individuals to family offices, don't require it as much. But as you get the pension funds, you're going to have to deal with the Cambridges of the world, the Mercers, the Askias, all the consultants. And there's a whole other ecosystem out there that you'll have to start to get to know and build relationships with as well.
I can offer one other thing, and that is, please be really careful about raising from friends and family. And I say that because you may have 110% confidence everything will work out great and you're going to make the money, but sometimes you don't. And I have unfortunately seen some families get destroyed by that kind of thing when it doesn't quite work out. Mom and dad put half their pension into a great fund idea. So please warn your network to be careful on that.